Amongst the challenges facing embattled platinum miner Lonmin was to find a long-term replacement for CEO Ian Farmer. Yesterday, the company announced that Amplats executive Ben Magara would take over as CEO from the 1st of July. Despite having a wealth of experience, the market did not take the news very well. Joining us from Cape Town to discuss the prospects for the company and the industry is Peter Major. Well, Mr. Major, you're not feeling very positive about the resource environment at all at the moment, are you? Can you enlighten us on your standpoint?
Look, I'm the guy who keeps saying the macros are great, the micros are bad, and the micros we can fix. But now one of the macros isn't great, and that macro is the dollar and its metal prices. The dollar's not really so strong yet, but its recent strength, say from 135 to the euro to 128, that's enough strength to hurt metal prices. And a lot of these metal prices, Bronwyn, actually peaked in 2008. But the party carried on. And now we're in 2013. If you start backing up, let's go through the oil price. Let's go through the iron ore price, the coal. A lot of these metals peaked in 2008 and they're still falling. You know, gold, has it peaked? I think it has, and that was in 2007. So it's really fighting a losing battle the last 2 years. And many of these prices peaked in 2007. So this massive bull run that made everybody a lot of money and let a lot of expansion and mergers and acquisitions take place, I think the bull run's actually been over for a year or two. And so this slowdown, it's evident all over the place in all the commodity prices, some worse than others. And there's just no way a mining company can make higher earnings when its revenue from metals is falling. Peter, and it's got high costs, and the high costs are like this heavy flywheel. You know, a metal price can turn down tomorrow. But when you have cost inflation of 15%, and that's been the world average in mining companies, 15% a year for almost the last 10 years. So that big flywheel effect is going to keep on going for another year or two. And that's really compounding the miners' problems to make money.
Let's get straight into it, Peter. So obviously with Amplats now trying to restructure that cost base because of the new fundamentals or the new paradigm. And we've got Lonmin that's trying to get back up on its feet as well. How much scope is there to do that in South Africa where losing jobs is so politically sensitive?
It's probably harder now than it's been in the history of mining, Warren. And that's my confirmed belief. Because there's too many role players involved in mining now. That the poor mine manager, not only does he have to consult with them, he actually has to work with them. You know, they all get to put their fingers in his engine. You know, you can imagine a great mechanic, and now he's got 5 other people that all want to help him work on his engine, or a cook in the kitchen. Now everybody wants their role in cooking. So I think the environment now to restructure and control costs and to even halfway maintain earnings, I really believe it's tougher now than in the history of man.
Just to bring in something that Ivan Glassenberg made quite forcefully in an interview a few weeks ago. He talked about supply control as one of the key features absent from the resources sector at the moment. I wanted to see if that is the new paradigm now in resources. Are we going to see these big mining companies really controlling capex and this notion of having to expand to make money? Is it going to require Ivan Glassenberg at the head of the new Glencore Extractor to bring this new era in, so to speak?
Look, it sure shouldn't. Any mine manager, any CEO of any mining company should have enough economics 101 that he knows better than to overpay for assets, to increase production in an environment of falling or weak demand. But if we look backwards the last 3 or 4 years, I know that hasn't been evident at all. So we like to laughingly say everybody was drinking happy juice, but they were definitely breathing bad air or drinking something or smoking something they shouldn't have. Because you shouldn't need to be an Ivan Glassenberg to realize I'm cutting my own throat, bringing on too much production.
Peter, I want to pin you down here. I want to pin you down. I want to see how far do you think the resources can fall from current levels? When you expect calamity going forward, how significant a drop-off are we going to experience?
Bronwyn, there's 2 things that determine the price of a company. It's earnings or its net asset value. And your earnings can go to zero real easy. We saw that with Amplats. Now, Amplats share didn't go to zero, so it's obviously being based not on earnings anymore, it's being based on net asset value. But there's a lot of gold mines closed down, like Grootfontein, that we thought had an asset value, and it went to negative figures. So boy, when you say how far can these things fall, they can all fall a lot lower if the metal price falls a lot lower.
We know, Peter, that we've had fund managers, the deep value fund managers on our show coming in and buying platinum stocks at this level. Are you interested in anything at the moment, or what are you doing with your portfolio? Is it a case of closing resources funds and signing up for cash, or what are you doing with your investors' money?
And further to that, are you putting that cash under your mattress, Peter?
Yeah, I temporarily am, Bronwyn. It's the lightest I've been in mining, because when the sector goes down, any mining shares is too much. And right now I've got a few mining shares and it's too much because they're all going down. I've got more cash available than I think I've had in 15 years. And hey, even today, I see these prices. I'm ready to go in and buy. I'm ready to buy Lonmin at 39. But I look at that platinum price and I say, gee, Pete, the long-term real average is about 930, and here it is at 1570. That's a heck of a big gap. The gap is too big. So I'm not going to buy anymore until I have reason to believe that these metal prices have bottomed. And when something's trading 50 to 100% higher than its long-term mean, I'm going to need a lot of convincing before I buy a share dependent on a price that high to make money.
Peter, are you getting a lot of pushback for your view at the moment? I mean, if we look across the board, many of the fund managers that we've spoken to on a daily basis, the value managers themselves are buying the likes of Anglo American and are potentially knee-deep in the stock. So you really are being contrarian on your view here.
No, I don't think so, Bronwyn, because you can go from 100% cash to fully invested before lunch. So, you know, I'll say this.
That gives us a little perspective. Of course you can.
Yeah. Every day you try and find the cheapest good value share and you buy a little bit. It's like just having a sip of alcohol, but you don't want the whole can of beer. And it's just not to whet your appetite, but to tone down that urge to run in and buy something that you haven't seen on a share price this cheap in 5 years. But we can't look at share prices. Look at these PEs. These mining stocks are now on a 17 PE. If earnings fall, they could go to a 25 PE, and that is not cheap for a mining stock. So it's not the share price that determines if it's cheap right now. It's actually the earnings potential.
And Peter, obviously being a commodity, demand's the story. We wanted to just touch on that before we finish. Obviously, a lot of talk around how much commodities and resources China are going to consume going forward, and what is the mix going to be. Is the case for iron ore, for example, is the boom period over now that we're seeing so much supply and yet smaller demand from China? What do you expect going forward from the country that has been demanding the most in these resources?
I have a cautious outlook, and I won't even say cautious positive. I don't have a negative outlook, but I have a very cautious outlook going forward. I'm reading too many stories about China from people that I've grown to trust and respect. You know, good fund managers, good economists that say China at maximum can keep this party going another 12 months. And we do know China's been goosing their economy with easy money more than the States has on a relative basis. And boy, we all know how much the States has been goosing their economy with cheap money. So, and China is not as efficient as allocating its money in the country as a more free market Western world country is. So yeah, China's been responsible for 40-50% of commodity offtake on most of these metals for the last few years. Now, can you imagine if one country's been taking 40-50% of offtake, or has been responsible for 40-50% of the growth in offtake? If that country just falters, if it just goes down to 3, 4, 5% growth instead of 9, 10, 11, 12 like it's been, we'll see more commodity prices come off.
Is that true even for oil and gas, Peter? Because obviously, you know, while they may not be building houses and infrastructure and roads, they might be consuming energy, and they still expect to consume a lot more energy, obviously, as a growing economy. But can you make the same points you've made for oil and gas as you have for things like iron ore and copper? Yeah,
I think you can. Gas, I think it is trading, gas is strange. Oil and most metals trade at the same price all over the world. But natural gas, you find out trades in Europe at 3 and 4 times the price it does in America. Now, you guys explain that one to me. Oil, though, I think oil could come down another $10, $15 a barrel. It can come below $100 a barrel. Iron ore is definitely coming down. I'll bet anything on that. I'll bet my house on that without a blink that iron ore is way too high. You know, there's too much of it out there. Its long-term average real price is probably around 40, 45. I don't know what it's doing up here at 130, 140.
Peter, you're obviously expecting some very negative news flow on macroeconomic fundamentals globally.
No, I'm not, Bronwyn. I just think these commodities ran so hard and strong on massive artificial stimulation, massive artificial demand. So I actually think one of the big negatives against gold is that the U.S. economy is improving, that the dollar is strengthening, and that interest rates might actually go up. And they don't have to go up very much. And that is such a massive negative for gold. So here, good news in the West is actually bad news for gold. A lot of people seem to have forgotten about that.
But let's get to the point of whether that is sustainable. I mean, this has all been on opening up the taps where money is concerned. It's quantitative easing. We can map the equity environment has rallied in tandem with that quantitative easing. It's not sustainable. When that liquidity is withdrawn, couldn't gold go through the roof?
Geez, Bronwyn, have you got a master's or a PhD in economics? Huh? I'm intimidated. You're good.
I'm taking that as a compliment.
No, it is a compliment. You're right. We are so far out of the realm of a normal economic cycle because we went to such an extreme with these low interest rates that even I, who like reversion to the mean, who believe in it, don't necessarily think we're going to revert to the long-term mean because we're too far out of the mean with how we've perverted our normal economic cycle. Your scenario, I think, has more than a 50-50 chance of being right. That this growth in the States, this improvement in the States, it could be fake, it could be false, it could peter out in 6, 12, 18 months. And then we go back to low interest rates again, maybe more stimulation, and gold can actually go back up. And that's why I'm not saying gold's going back to 600, its long-term average, or platinum's going back to 930. I'm just saying they're too far above those averages, I think, to sustain where they're at. But yeah, we could have falters in this world growth. But gee, what if it all goes into a slump?